What are estimated taxes and who has to pay them? Today, we answer common questions we receive from clients about estimated taxes. Estimated taxes are tax payments you make on your own throughout the tax year to satisfy your tax liability when your employer does not withhold any tax or enough tax. If you owed tax for 2014, you may be required to make estimated tax payments for 2015. If you are filing as a sole proprietor, partner, S corporation shareholder, and/or a self-employed individual, you should make estimated tax payments if you expect to owe $1,000 or more when you file your return. Estimated taxes are based on the prior year's information, so your 2015 estimated tax payments are calculated from the tax you owed for 2014. You should make estimated tax payments if you expect your withholding to cover less than 90% of your 2015 tax or 100% of the 2014 tax you owed. However, for higher income households, if your adjusted gross income AGI for 2014 was more than $150,000, $75,000 if filing single or married filing separate, you must make estimated tax payments totaling 110% of your 2014 tax liability. Estimated tax payments are typically made 4 times for the tax year, in April, June, September, and January. How do you pay them? Estimated taxes can be paid with checks, money order, or online at the IRS website. IRS Direct Pay offers the convenience of having the funds directly transferred from your bank account with no additional fees. EFTPS requires registration, and it allows you to schedule payments up to a year in advance so you won't miss any payments or deadlines. Mailing a check to the IRS is always an option. Be sure to write your Social Security number and the tax year your payment should be applied to on the check. You'll also want to mail your check to the correct address, as the IRS has many service centers across the country. Sending payments to the IRS via U.S. certified mail and keeping a receipt for proof is always a good idea. Many taxpayers want to know how serious the IRS is about estimated tax payments. Are they required? Will you be penalized for missing a payment? Yes and no. If you do not make payments and owe over $1,000, the IRS will apply a penalty to the balance owed. That being said, the IRS is not going to take your house or send nasty letters if you miss a payment or don't pay any estimated taxes at all. What if my income changes? Keep in mind that estimated taxes are just that, estimated. If you know your income will be greater or less than your 2014 income, you can make payments based on that figure. You can recalculate your payments during the year to reflect a higher or lower income by increasing or decreasing your payments. In sum, estimated taxes are payments made by the taxpayer when your employer does not withhold any or enough tax. Payments are generally made quarterly in even sums, but they may change if your income is irregular. Making estimated tax payments can help prevent surprises at tax time, so you don't face a large tax bill and penalties. For more information, or if you still have questions, visit www.irs.gov or contact your local CPA.